Hello, everyone. Thank you so much for joining me today. My name is Shweta Lawande, and I am an advisor here at Francis Financial. Today, I will be sharing our insights into this month's market performance. And as the market and the world at large continue to change rapidly, each month your Francis Financial advisors will be sharing the market trends that impact your portfolio, the investing strategies that make the most sense for you, and how we will continue to help you grow and protect your wealth. So you'll receive these videos straight to your inbox each month. And as always, feel free to send us an email, give us a call, reach out to us with any questions you might have. We're more than happy to answer them. So without further ado, let's take a look at market performance for the first half of this year as we think about July and onwards. And given what we've seen over the past few months, it doesn't come as a surprise to us that most, if not all, asset classes are down for the year. And we can see here that US growth stocks and US small cap stocks have suffered the most. Interestingly, in a shift that we've been noticing on a more positive note is that bonds are the yield that we're seeing with bonds is starting to move up sufficiently so that they can begin to act as a stabilizer in portfolios while stocks continue to battle market volatility. So essentially, the increase in interest rates have made it possible that the additional income we now stand to earn from these bonds is offsetting the changes that we've seen in the price of bonds. So it's making bonds that much more of an attractive investment during these times. And that's another kind of reason that we are so focused on diversifying investments. And diversification is something that I'm sure you've heard us at Francis Financial preach for years and years. And what's interesting is that even during a time like this, where all asset classes are being faced with challenges, there still is a benefit to diversifying your long-term investments. We're seeing that now with bonds becoming that much more attractive, while market volatility is still very much on the table. But we even see that if we shift our focus from just the past 6 months of market performance to the past 36 months of market performance. So you see here the gray lines on this chart, which represent the past 3 years of market performance, even taking into consideration this most recent volatility, it shows a vastly different picture of market performance than what we're seeing at the moment. So a couple of takeaways here. One, diversification can truly reduce the experience of ups and downs in a portfolio for a long-term investor, but also the long-term piece of that picture is vastly important. In order to see the types of long-term positive returns in your portfolio, staying invested through these rather difficult times is part of the deal. It's what's going to get you from the more dismal return numbers that we see for this year to the much more positive and growth-oriented numbers that we're seeing over the past 3 years. So certainly what we're focusing on now for our clients is how do we continue to stay invested during this time, and how do we continue our efforts to diversify our clients' investments across market segments, across stocks and bonds, across international stocks and domestic stocks, and taking it even further from there. On the economic front, the most recent inflation reports came as a surprise to everyone, as many economists and investors alike had thought we had already reached a peak there. But what we've seen is housing costs, energy, and food costs were the biggest drivers in these latest results. And as a result, we've seen stock prices continue to take a hit. In response to this inflation data coming in higher than expected, the Fed predicts they'll continue to increase interest rates. And what that means for us as stock market investors is that there will likely be more market volatility on the horizon because rising interest rates is tough on stocks in the short term. Borrowing costs are increased for companies, and the values that these stock analysts assign to these different stocks tends to come down as a result. On the bond side, bond prices, as we know, are negatively impacted when interest rates go up, and these older and more longer term bonds with the lower rates are valued less than the newer bonds, which now get to claim these higher interest rates. So, what we expect to see going forward is in response to this inflation, as the Fed continues to tinker with interest rates, we're in for the ride. We're going to see stock market volatility, and we're going to see bond prices find their new normal as interest rates move. Now, the next Fed meeting will not be until September. So, this break between now and then will likely provide a period for the stock market to digest these initial rate hikes and for the Fed to see how the economy reacts to their movements. And when they are looking at the reaction, what they're focused on is how does employment and inflation react to these interest rate hikes? So the what's interesting is that the US economy remains pretty strong with low unemployment and strong consumer spending. And what this indicates to us is that if a recession does occur, it would likely be a lighter recession with a quick recovery. There are also opportunities to be taken advantage of right now in the market. First, on the bond side, with bond rates becoming more and more attractive, but also on the stock side, where you can use any cash that you have on hand to essentially purchase stocks at a discount during this time. So, overall, the best things we can do as long term investors in these market conditions are to one, stay invested in the market as much as possible, to diversify our investments, knowing that different areas of the market will begin to recover at different times and for different reasons. And for number three, to look for opportunities to add to our long term savings. So, using cash on hand to enter the market during this time is something that we're pushing all of our clients to do. And we're helping them stay focused on the larger picture of their portfolio, which, of course, for anyone who works with Francis Financial, is a beautifully diversified, long-term portfolio. Some other opportunities that your advisor may have already spoken to you about is harvesting losses in any taxable accounts to offset capital gains in your portfolio, converting traditional retirement accounts to Roth accounts. While these account values are temporarily lower, and so, the tax impact of these movements are lower as a result as well, and also dollar cost averaging into the market with any investable cash on hand. So, three things to consider doing immediately with your financial picture, and of course, talking to your advisor about how these strategies apply to you and where you can take advantage of some of these movements. As always, our focus at Francis Financial is on optimizing your financial picture, not just over the next, 3, 5, or 12 months, but the 3, 5, 10 years of your financial lives. So, of course, if there's anything on your mind, anything that you'd like to discuss about your portfolio, your financial plan, making tweaks during this time, please feel free to reach out. We are here for you always and are excited to help you weather these market volatility times and to see you through to better market environments.